Welcome everyone to Wealth Without Wall Street. Lupe, did you want to share out the slides?
Yeah, I'm going to share the slides, and we have a very exciting topic tonight. I think the one we all care about is financial planning. So here we go. Can everybody see this?
Yes, we can see it.
Let me put the presentation. Is it full screen now?
Yes, it is.
Yes.
Okay. Hey, welcome again, everybody. So tonight we have Michael with us. He's a financial planner, and he's gonna talk to us about financial planning in uncertain times. So really looking forward to it. This is us. Let's start with Tiffany.
Hi, everyone. I'm Tiffany Span. I'm co-founder and partner. I'm responsible for operations. So I'm behind a lot of the day-to-day operations that occur. I'm really excited about this evening. Thursday evenings have started to be my favorite evenings, and being able to share in on everything that we know and just bringing new ways of building, creating, and just preserving wealth. I'll pass it over to Noel.
What's going on, everybody? If you have a camera, turn your cameras on. You know I love that energy. I love to see you guys. I am Noel, former pro athlete, former scientist, full-time multifamily real estate syndicator. I do asset management, and if we're going to do real estate here at Crown Capital, we're going to make it look sexy. So I want you guys, be excited to be here. I'm excited for you guys to be here. I'm excited for what Michael has to share for you. Lupe?
Welcome again, everybody. I'm Lupe. So during the day, I am actually active duty, serving the military. I'm passionate about real estate. I got into it about 3 years ago and never looked back, of course. There are ways you can still get involved and do real estate or investing, even if you have a full-time job. So I'm doing it. So if you're interested, definitely that's something. It's not a conflict that you'll be able to work it out with your day job, and hopefully, have something more than your 401k for retirement. So, and I'll turn over to Noel to introduce our guest speaker.
So I want to introduce to you Michael Hartzell. So he's a financial advisor, financial planner for Mass Mutual. I have used him personally most recently. So again, I'm excited for him to be here. He's helped me out tremendously. And so Mike, go ahead.
Good evening, everyone. Thank you for having me. I'm excited to do this. There's a lot of things to talk about tonight. A few ideas I wanted to go over. I guess first is if anybody has questions about just where the market is, how 2022 was, and what a lot of analysts believe will happen moving forward is something that I would definitely like to talk about. I want to introduce, secondly, somewhat of a new topic that kind of, it's more relevant with financial planning now, specific to retirement income planning. It's more of having multiple buckets to choose from when you go into your retirement distribution years. And then at the end, I would like to just kind of open up the questions. And I guess if we were to start, does anybody have any specific questions for me before we start, or anything specifically that you wanted to cover?
So I have some questions that were placed in my DM for some of our shy viewers out there. So there's some people want to know if you are still your W-2 have W-2 employment and you just switch jobs. Is it better to roll over that former 401k into the new job, or should you put it in the self-directed IRA or another kind of 401k and then have your new job kind of build on its own? What would be the preference?
Good question. So there's 3 options when you leave a former employer and you have assets sitting in their retirement plan. The first is you can leave it there. Some might want to do this because they really like the investments in their former plan. Some might like it because they're really used to the website and the convenience of it. I would tell you that's probably the worst thing to do out of the three options, because one reason would be in the event that the company were to default or switch providers who administer the 401k, it's a nightmare trying to obtain your assets. And I've seen situations with other clients where it's been a nightmare trying to obtain them, and it goes to abandoned property through the state in which you live, etc. So I would not leave it there, but that is option one. Option two is you can typically 9 times out of 10 roll it into your new employer plan. Some people like that just for simplicity. I wouldn't really encourage that either, just because whatever is offered through your current 401k or 403b plan, as far as funds go, is that's what you have to use if you roll it into your new employer plan. So you're limited to what is available out in the marketplace because you can only use what your employer offers. The third would be, Noel, that you mentioned, is to roll it over into your own IRA. It stands for an individual retirement account. It's a tax-free, penalty-free transaction, and it allows you, or with the help of an advisor, to manage your assets on your own and to get it out of your former employer's name. Okay, so you control the asset, you call the shots on it, and it's yours. So that's typically what we'll encourage clients to do, is to roll it into their own IRA account.
Got it. And I had other questions there saying, sometimes people don't even know where to start. So would you be able to offer advice how to, I guess, retirement goals and helping build for saving plans to meet those goals? Is that something that you could do?
Yeah, so yeah, absolutely. So that's really where we specialize, is retirement income planning. And the first thing you want to identify is an approximate year in which you want to retire. And that's probably obvious, but normal retirement age nowadays is really full retirement age in Social Security at 67 years old. Okay. And what you want to really do is identify, okay, how much did I used to live off of while I was in my earning years, and how much can I spend, or what do I want to do in retirement? Do I want to travel? Do I want to buy a second home, etc.? I will tell you the average American has to save anywhere between 10 to 15% per year on average into any type of retirement vehicle in order to live off of 75% of their net income while they were working. So in order to replace 75% of what you used to make, you have to save 15%, give or take. Now, the easiest answer is you should do whatever is affordable, or you should save into your plan whatever you have to get the employer's full match, if you're lucky enough to have one. That's financial planning 101. Another couple ideas we have for clients, which I'm about to get into, is you always want to look at your tax situation. So oftentimes it would make sense to save into what's called a Roth IRA, or excuse me, a Roth option within your 401k. Does anybody have that now?
Put your hands in the chat if you have it. Let's see in the chat. Any hands raised in the chat for it? If you have that, we have donuts. Why don't you explain that there?
So the difference in pre-tax and Roth is that I like to use this example. If I make $100 per year, so if I save $10 or 10% of my pay of $100 per year into a pre-tax retirement asset, the government is then only taxing me like I made $90. So it's lowering the your taxable income for the year in which you're putting money in. All of your contributions that go in, they compound over time and they grow. And what happens is your account is being tax deferred. You're not paying taxes during that time frame. But when you get into retirement and now you have to start pulling out money to live off of and dispersing it to yourself, you then have to pay tax every time you touch it. Okay. So pre-tax helps you on the upfront. by lowering your taxes or your taxable income in the beginning or while you're saving, you have to pay taxes in the back end. Roth is opposite. I make $100 a year. I put 10 into a Roth. I'm still being taxed like I made 100. So it's an after-tax contribution and doesn't help your taxes for the year in which you're saving. Everything goes in tax-free, and then when you pull it out at retirement, every dollar is tax-free when you touch it. So the question is always, hey, Mr. and Mrs. Client, where do you think taxes will go over the next 20 to 30 years or even 10 years? The answer is probably up, but we don't know. So we rather clients pay the tax now, 9 times out of 10, as opposed to deferring it into an uncertainty type of situation. But yeah, any other questions before I share screen? I want to show a couple of different scenarios.
Got it. We have a few, but I'll do this last one and then I'll let you jump in and we'll answer some more of them. So there's this concern if you're on the latter end of your career and you're concerned about your pension or your 401k. Most notably, they're noting in Kentucky, there was a teacher's pension plan that lost $3 million because it was invested in Russia. And so when it happened to the war, they lost $3 million. So they didn't know where their money, they were contributing, but they didn't know where their money was vested in. Is there a way to either kind of, I guess, bet more where your money is going and or pull that out and go elsewhere?
Yeah, so the question is, I guess, how do you get just complete conviction on where the money is being invested if you're saving it into any type of plan?
Yep.
Good question. So most employers, if done correctly, should have a financial advisor associated with the plan that comes out and is available at least once a year. I would rely on he or she to look at your asset allocation. If you're more do it yourself, you have two options. The first is the most suitable way to go about saving for retirement within your plans, or even if you do it yourself, is to put it in what's called a target date fund. So a target date fund, they're typically given out in increments of every 5 years. So there's a 2020 fund, 2025, 2030, all the way up to 2060. And it's set it and forget it. So whatever approximate year in which you're going to probably retire, you would pick that fund. Okay, so for me, I'm 31. You know, if I want to retire 30 years from now, I would probably pick something like the 2055 fund. Okay, something around the approximate year where I am. So so they're suitable, they're set it and forget it. They're more aggressive the further away you are from the target date year, but as you keep getting closer and closer, it'll automatically turn back the aggression internally within the account. So in that scenario that you just asked the question, that, you know, most retirement plans aren't investing in speculative type of things, but that's what I would suggest. The other way you could protect against it is you could look at your fund lineup, all the funds available through your plan, and there's a website. If you Google Morningstar, it's all one word, Morningstar, and then you put the fund name or the ticker symbol in Google search and find the link. It's a third-party website that rates mutual funds individually. They give them a 1 through 5-star rating. It shows you how aggressive they are versus other like funds. That shows you past performance, and it's a free service. So I would use that.
Okay, so Michael, if you want to go ahead into your presentation, and then maybe we can circle back around with some more questions. We did get one in the chat as well.
Okay, great. So before I share screen, this relates to millennials. This relates to those approaching retirement, or even, you know, people in between. Is there's a whole new philosophy on retirement planning, and the main reason is because most employers nowadays do not offer pensions. The old adage was, growing up, you know, you have your own Social Security, and then you have a pension plan, which are going to spit off, you know, X amount of dollars per month, and that's what I'm going to live off of. And I don't have to really have my assets, you know, generate a lot of income for me, because I have those two guaranteed inflows through Social Security and my pension. Now that pensions are less relevant and employers kind of gone away from them, it's important to create, in our opinion, at our firm, multiple buckets of money to choose from in retirement. So the corny analogy is mountain climbing, okay? And we relate that to retirement planning. So when you're climbing up the mountain, we equate that to the accumulation side of your retirement. You're trying to turn your income into assets, all right? You're trying to grow the biggest bucket of money as you can until you get to the top of the mountain, which for this case is your retirement age, okay? No one in my industry that does what I do for a living talks about the second phase of retirement, which is the disbursement phase, okay? Most times, candidly, financial advisors only talk about accumulation because that's how we all get paid. But the disbursement side is just as important. And the corny analogy with it is when people are mountain climbing or rock climbing and they have issues or get in accidents, it's because there's really not a game plan to come down. There's always a game plan to go up. So we want to think about strategies now to help us in our disbursement years in retirement. Okay. So if I were to ask everybody in the chat, what do you think what percentage of your assets at retirement you're supposed to pull out per year? What do you think it would be if you had $1 million saved? How much are you supposed to pull out per year to live off of mathematically? Any answers? Yeah, good point. Yep. So we have 60 grand. I saw no more than 4%. Very good. This graph should show you. Let me know when you can see this. You guys see this?
Yeah, we can see the graph.
So this is just kind of showing or putting math behind those answers. So the correct answer is you want to be as close to 3% as possible, 3 to 4%. And there's a few reasons why, but really I just want to explain this graph. The right-hand side shows you at retirement what percentage you're pulling out to live off of per year. Okay, so if I have $1 million, that'd be 30 grand here, 40 grand, 50 grand, 60 grand, all the way down to 80. The bottom shows from the day you start retirement until death, how many years you would live. Okay. For our clients' planning purposes, some people say, you know what, my family has it does not have longevity on our side. Some say, yeah, my parents are living into the late 90s. So for planning purposes, we typically want to be around 30 to 35-year retirement. And then the left-hand side as a percentage shows what your probability is of not running out of money. Okay. So you want to be theoretically in this 3 to 4% window when you go to retire. If I had $1 million and I was withdrawing 30 or 40 grand, these are your statistics. So if I have a 35-year retirement, I have a 95% chance of not running out of money. 4%, it's still pretty good. It's about 75% chance of success. But that's not 100. And our goal for clients is to get as close to certainty as possible. The real issue here is 50 grand versus 40 or 30. If I had $1 million, is not a ton of money per year. But look at your probability difference. So you're under 50% if you pull out 5% a year within the projections. And then, we have a lot of clients that will say, well, why is this? Obviously, it's because we're pulling out more money. But there's really two reasons why there's such drastic numbers here. The first is, which we already kind of hit on, is there's longevity risk. If you know exactly what year you're passing away in retirement, I probably shouldn't have a job. Number one. Number two, because it would be easier to plan. Number two is there's a huge difference between constant average rate of return, meaning, over the last 10 years, I averaged 7% a year on my investments, versus the sequence of the return. So that doesn't mean last year, like 2022, I was down 18%. The year before, I was up 20. So even though I might average 7% a year, if you pull back the onion and you really dissect each year, there's a lot of ebbs and flows. All right. So that philosophy, I want to just relate real quick to a brochure and then just open it up to any questions. So let's see here. Okay, good. Can everybody see this? Yeah, okay. So this kind of just puts a live scenario into what we were just talking about. So if you see here, this is a client of our firm back in the day in 1995, retiring and living till 2009. And if you see this top left, he or she started with $2 million in their 401k. All right. Withdrew $150,000 per year to live off of. All right. I've done this plenty of times. I could tell you, without pulling out a calculator, that's a 7.5% withdrawal rate. So this client is down here, violating the 3 or 4% rule pretty immensely. Okay. So anyway, started with $2 million, pulled out 150 grand a year to live off of. Aggregate about 2.25 million was pulled out over a 15-year period. The second column from the right, you can see what the S&P 500 index did over that 15-year period. It averaged 10.4% per year over that 15-year span. So this person, even though they pulled out 2.25 million and violated the 4% rule, ended with $3.3 million. Okay. Sound fair so far? Good. The second person has all the same statistics, as you can see. So started with $2 million in their 401k, pulled out 150 grand a year to live off of. The S&P 500 still averaged 10.4 a year, but theoretically, this person ran out of money in year 13. Now, the reason why that is what this is trying to illustrate, is even though this person lived in the same 15-year period, just imagine living from 09 backwards. So just flip the years and when they occurred. Even they both earned 10.4% on average per year. But look at 2008. Okay, 2008, the market lost 37%. This person was violating the 3 or 4% rule at a high number and was withdrawing at such a severe loss. Okay, we call the last 5 years of your working years, for football fans in here, go Eagles Saturday, and your first 5 years of retirement as like your retirement red zone. It's like being on the 20-yard line in the NFL. Okay, you have to be careful with how your investments perform in those in that time frame. So as you can see, this person ran out of money, and the reason being is you never want to sell low. You always want to buy low and sell high. So as you can see, this person's 401k balance went from 2.2 million almost to 1.2 after this negative 37%. So the long story short of it, and this is kind of getting into your side, Noel, is there's a few ways to protect against this. We have some financial products that can protect against this for the future, and so do you guys through your real estate endeavors. And it's really, if you just take the chart that we just went over, and you see the year following a crappy market, this person had another bucket of money to pull from the year following whenever the market was severely negative. Okay. So the same person that ended up with zero money actually now has $2 million saved over the 15-year period, because this person took on an offensive and defensive approach. Investments being the offensive approach. So we want to pull from our investments when the market's doing well so that we can live off of. We want to pull from a non-correlated asset or a defensive strategy when the market's struggling. That way we can allow our investments to recuperate and we don't pull from them. And then from years after, we go right back to pulling from the investment. So it's the give and pull of having multiple buckets of money to choose from, so that way you can be more reactionary in retirement and figure out where you're going as far as what bucket to pull from versus only having to pull 3 or 4% a year if you go all investments only. So long story short, the uncorrelated asset, oftentimes we have clients that'll use it in real estate. We have clients that'll just use a money market or cash position. The issue with that is it doesn't give the best rate of return, but it's safe. And the third option, which Noel and I went over, was there's certain types of life insurance that have a cash value component similar to real estate and bank accounts, where you can grow the cash value and use it while you're living at about 4 to 5% rate of return per year, guaranteed. So that's basically the new philosophy, is to have multiple different avenues to go in retirement or income years. So hopefully I didn't ramble too much there, but I hope this resonated.
Absolutely. I think we had a question there. What are the different buckets people should have?
Good question. If you're talking specific for retirement, the perfect balance in our philosophy is to have as much money as physically possible in tax-free buckets of money. That being said, it would be Roth 401k options. It would be Roth IRA. It would be brokerage account monies, non-qualified monies. And we truly believe in putting together permanent insurance to go along with investments. I think permanent insurance is quite frankly sold incorrectly. Meaning I think most families that are younger and have young children and have big mortgages and need to kind of protect now for a cheap cost, I think should be term insurance. But permanent insurance you could use as you can use as an asset. So basically the answer is I would say Roth, IRA, 401k, cash value life insurance, or permanent life insurance. And yeah.
And I'm throwing in multifamily real estate investing in there as well as my other bucket there.
Then, and that's true. You should. We encourage clients to go into that. You can explain that much better than I, but yeah.
Hey, Michael, I think that was a good segue to Jesse's question that he asked earlier. So the question was, it's good to start a Roth IRA years in advance of retirement. I'm 62 and retired with a TSP. So I would be taxed heavily if I roll over the TSP to Roth IRA. So for people who's already in the position that didn't set up any kind of Roth and approaching retirement age or already in the retirement age, what do you recommend in terms of tax strategy, or if any other product can be a good alternative?
Yeah, oftentimes it's a case by case basis, but it doesn't typically make sense to convert from a pre-tax asset to a Roth during any income earning years, because whenever you go from pre-tax and transfer or roll it over into a Roth, that dollar amount that you execute will be added to your gross income. And therefore, I would roll that over the TSP. It's a tax sheltered plan. I would roll that into a traditional IRA, and I would start a Roth IRA fresh. Or while you're in your retirement years where you're not going to have much income, you can think about doing what's called a Roth conversion, where we're going to convert a chunk of it, say 50 or 100 grand, from a pre-tax vehicle into the Roth, and just pay the taxes. It'll be added into your income, but theoretically there'll be a net wash because you won't have much income in your dispersing years. So that's really your two options. Or I would roll it into an IRA and just save Roth for that time, that short time frame until retirement.
So we have another question here come from Jesse. What are the typical fees for using a financial manager. Maybe we should break that down to financial manager, fiduciary, fee-based. We can go into some detail for that. For those
Yeah, so it's a hot topic with the Department of Labor. And I agree with a lot of the change. Back in the day, financial advisors usually charged pretty extreme commission. And that's really gone away. So what the Department of Labor wants financial planners to do is act in the fiduciary capacity, which means we have to do what's in the best interest of the client in any situation. And with that being said, over the last few years, it's changed more to fee-based financial planning. So similar to a CPA or a lawyer, if you wanted to hire someone like myself to do your financial planning, regardless if you implement investments with us, insurance with us, etc., to create your blueprint and to hire me as your sounding board on any financial decision, we'll charge typically a financial planning fee. It's an unbiased way of approaching it as the financial advisor. And those fees range, for a simpler plan where there's not much complexity, whether it's, business owner or a big complex tax situation, will typically charge anywhere between $1,000 to $1,200 a year. For bigger situations and for more complex situations, about $2,500. The second part of it is product implementation. If you were to buy an insurance product with a financial advisor, it's typically still commissionable, but there's nothing built out of pocket for the client. It's just built into what you pay per month or annually in your premium. But again, getting back to the Department of Labor, if we're going to manage your money for you, or you're going to roll over an old 401k to us, and we're going to actively manage an IRA, we try to get clients. We're pretty cheap. Industry standard, most advisors are about 1.5 to 1.4% all in per year. We try to get it as close to 1 as possible. So those really are the ways in which we're paid.
So we have a question again. How does life insurance serve as an asset?
Good question. So it's not an investment. The specific one that I'm talking about is called permanent whole life insurance. It's not an investment because it's not volatile. It doesn't have the ability to lose. It only can grow. It's more of a fixed approach. Hence, that's why it's not called an investment. The definition of investment is there's an opportunity for profit by giving up the ability to lose value. So there's no investment part of whole life insurance. It's an asset because the cash value, when you go to look at your net worth statement, balance sheets, etc., is actually an asset on those balance sheets and those documents. So it's really just another spoke to the wheel as far as different types of accounts you can have leading to retirement. The other reason I like it too is you can use it for whatever you want. Whereas retirement accounts, you typically have to wait until age 59 and a half to access them before there's any, if you access them before the age of 59 and a half, there's a 10% penalty most times. So, whole life insurance, we'll use it as a college funding vehicle. Oftentimes we'll pair it with 529 accounts with your college vehicles. So yeah, that's why it's an asset.
All right, we have another question from Miguel. It's any thoughts on the potential for the government to drop income taxes in favor of consumption tax? And then it's a two-part question. Then when creating a secondary pool of money, specifically for protecting against market downturn and retirement, what asset types would you recommend? I can take that second one right there for you right there, because I would say multifamily real estate, Miguel, over the last 15, actually 20 years, multifamily real estate has outperformed the market almost twofold. So take it from me, that plays in both realms. I am enjoying multifamily a lot better than the stock market, but I'll let Michael answer that first part.
No, that's perfectly said. We would encourage clients to have a piece of their puzzle to be into real estate. The other options, like we mentioned, is you could use bonds. You can ladder bonds. with different maturities. Bonds are interesting. In 2022, the US bond index was down almost double digits for the first time in quite some time. That's just because of how quickly interest rate rose, because they have an inverse relationship. So you could use bonds. Oftentimes we have clients that will just use a cash position or a high yield savings or money market position, get it outside of the marketable feature of an investment. And then, like I said, the whole life insurance is often used, and then bonds and real estate. So really four.
Thank you.
Great. We have one from Shaman. Hope I'm pronouncing that correctly. How much is recommended to pay into your whole life insurance?
I don't, it's not like a blanket answer. A lot of our clients, we won't even start with whole life insurance because it's much more important to cover their lives through a cheaper term policy. I'll back into that answer by saying this is a little bit complex, but our philosophy at our firm for retirement planning is if you're able to have as much permanent death benefit equal to all of your total assets at your retirement age. For example, if you have $2 million accumulated in all of your assets by age 65, and that's when you're retiring, our goal is to have about $2 million worth of permanent life insurance death benefit. So to back into that question, it depends on really your age, your health, a lot of factors. But I would probably start, if you're just starting to save, you want to, financial planning 101 is you want to take advantage of the free match through your employer's plan. So if I had to put in 6 to get 3, I would start there. And then I would probably, increase that over time. And then I would slowly start to trickle in permanent life insurance, but not until I really get a base going with my investment.
Got it. I have another one coming in via text message. And this one is regarding 529 and when to start it and how to utilize it. For me, I do have a 529, and I normally speak to it through real estate because I use it as a tool to fund my son's 529 plan. I also use it as an opportunity to teach them about financial principles. So for that and my nephews, I want to teach them, about taxes, stocks, appreciation, compound interest. And I think we need to always keep in mind, like there was an old standard I used to hear that, I got mine, my child has to get his. We need to make sure we're passing that down, that generational wealth, and making sure those kids are passing it down. I think the statistic now is that 80% of people lose their wealth by second generation. So, we want to keep that in mind of, I know I would be a hypocrite if I would say, no, I'm doing this for, my son and my nephews and other family members, and how I let, real estate fund their programs. Mike, how about you on starting 529s?
The earlier you can do it, the better, obviously, for the compounding feature. I will say there's many vehicles you can use for college, though. What we try to often do for clients is to, similar to what we just talked about with the retirement focus, is we had so many clients this year that had 50 or whatever the number is, 100 grand in a 529, and if it was invested properly, it was probably down 15 to 20%. Again, the last bucket of money you want to pull from is an investable asset, the years in which the market's down. So what we had a lot of clients do is, in Noel, your field, we had some people use HELOCs or home equity line of credit because it's a tax-free event. And typically the interest rate will be around or lower than what an average privatized student loan is right now. So we had a lot of clients use that. 529s are great. The Secure Act 2.0, which actually just came out, has made it more advantageous for clients to use 529s. it used to be with the old rule, if I have a 529, and let's just say my kid goes to college and or doesn't go to college, let's use that example. The old rule was for any amount that was not used, you had to pay tax on the growth at about 15% and a 10% penalty. So 25% haircut if it wasn't used for college. Whereas now you can use it for any type of education, whether it's grade school, middle school, high school. You could use it for dorms, you could use it for books, really anything that you can justify used for any type of education. So oftentimes we will use a 529. I like 529s. We will pair it with real estate. We'll pair it with what's called an UTMA account, which I can get into. And then again, not to keep beating a dead horse with the permanent insurance, but we'll pair it with permanent insurance too, because if the market was down when my kid was 21 years old, I don't want to pull from the 529. I want to use it for their senior year because I know the market will probably come back, and then I would pull from their whole life and let the 529 come back up and use that for future years.
Thank you. And I think that's a good segue for the UTMA. And then I think the other one is like UGMA, you know, what are the differences between those two? I know you set one up for me for my son right now. Again, everybody knows I do real estate. So my son's a partner of mine. So my rental income funds that every month there, but Michael's the one that set that up for me. Why don't you go into detail of that?
Yeah. Yeah, so the UTMA stands for, the acronym stands for the Uniform Trust to Minors account. Uniform Transfer to Minors account. So basically it's a minor brokerage account where a lot of parents like this because you can invest it similar to a 401k or an IRA and mutual funds and stocks and bonds. And the beauty of it is, you know, you basically own the asset until the child becomes age of majority in the state in which you live or reside. So for example, Pennsylvania, your son or daughter wouldn't become the owner of it until age 21. A lot of parents like that. The other part of it is there's something called what's called a kiddie tax. So there's many tax advantages to using it, where there's a certain threshold of gains, like $2,500, that will be taxed at the child's marginal tax rate, which is obviously much lower than the parents. And you can invest in really anything that exists: mutual funds, stocks, bonds. So that's another good vehicle. UGMA is basically the same thing. There's just certain states that don't let you do an UGMA versus an UTMA. UGMA, no matter what state you live in that you're allowed to do one, the asset becomes the kid or the child's at age 18, whereas UTMA, it's dependent upon the age of majority in the state in which you reside.
So you put money into the first account you discussed pre-tax?
No, both of them would be after tax, similar to a Raw.
Wow.
Yep. Now there's some 529, depending on what state you reside. We can talk about this offline because it's pretty complex, but you could get some state tax deductions depending on what state you live in. But it's not a pre-tax deduction though. It would just come from checking or savings.
Got it. We have a question for Ash. Ash, want to go ahead and unmute yourself and ask that question?
Certainly, thank you. Are you able to hear me?
Yes.
Okay, wonderful. So what are Michael's thoughts on these? I think I forget what those types of insurance plans are, but they are marketed as be your own bank.
Mm-hmm.
And I'm not sure what exactly they are and whether they really are beneficial or are they more like a gimmick or, that will be most helpful. Your thoughts on those kinds of insurance, life insurance plans.
Yep. So there's multiple different types. To answer your question on being your own bank, the analogy simply means that when you have a permanent whole life insurance policy, each year, depending on the strength of the company you have it with, you're typically given what's called a dividend. And the reason for that is you want to own a permanent whole life insurance policy through a mutual company. For example, Mass Mutual, who I work with, a New York or excuse me, Northwestern Mutual or Penn Mutual, the bigger ones. The reason being is none of these companies that are mutual are publicly traded. So obviously with a publicly traded company, the goal of the profits is to be then given back to the stakeholders or shareholders through a dividend. Whereas with a mutual company, those that own permanent whole life insurance through that company are given back what's called a policy dividend. So your premiums going in plus a dividend is compounding and growing two buckets of money. One is a living residual cash value that you can use and borrow from yourself. That's the creating your own or being your own bank scenario while you're living. And then you have a permanent death benefit that grows over time. So being your own bank, what that means is, so if I have 50 grand of cash value in my account or my whole life, and my death benefit's worth, let's just say 150,000, and I pull 25,000 out, you create a policy loan. In the IRS's eyes, because it's a loan, it means it's a tax-free event and transaction. So you're basically borrowing from yourself, similar to what you would do through a bank. The differentiator is through a bank loan, you would obviously have to repay it. Through a whole life insurance policy loan, you do not have to repay it. And the policy values continuously grow while you have a loan on the policy. The way the insurance company is then repaid is upon your death, they will deduct the loan balance from what your death benefit grew to, and that's what your benefit will receive. So that's the idea of becoming your own bank, is to develop enough cash value. So opposed to going to a bank, you can just borrow from yourself and you can repay the loan if you want. You don't have to. There's a lot of flexibility with it. And that's why, believe it or not, a lot of real estate investors utilize it too, so that they can buy properties with it. And it's similar to pulling out an equity line of credit almost, if you think about it that way.
Yeah, so we're going to actually have a webinar on that and how we utilize that to buy real estate. So I believe that is maybe second quarter, Tiffany, or when is that coming up?
February 23rd.
February 23rd. There you go. So sooner than that. So we all have that and how you can utilize that.
Thank you.
Yeah, you're welcome. There's a good question on annuities if you want me to answer that.
Yeah, so we have
Sure.
what is your from Tawana? It's your opinion about individuals' retirement annuities with a guaranteed annual income rider.
Okay, so if you Google an annuity, you're going to hear some horror stories, and probably the same with permanent whole life insurance, quite frankly. But some clients it's suitable for, some it's not. I actually use them, a decent amount. Your specific question is my opinion. I think, let's just face it, an annuity, the only purpose of it is to guarantee something, whether it's future income, safety of principal, death benefit, etc. They're very costly most times. So if you're able to get over the fee, I use companies named Jackson and Bright House, which used to be MetLife, and typically their fees range between 3 to 4%. If you can get over the fee component of it, then I think they're very suitable. Getting back to the pension topic I talked about, there's not many pensions that exist anymore. So basically, I believe in the variable annuities that have the income riders, depending on the situation of the client, because you can essentially pensionize your own monies. So if you have, 500 grand sitting in a 401k, for example, or something like that, and you want to take 100 grand or 150 grand just to guarantee a future income, yeah, they certainly fit. You're pensionizing your own money. But clients have to get over, it's tough to get over the cost associated with them, because those riders cost a lot of money. But I do like them.
All right. Have about 9 more minutes. Any questions for Michael? right, I don't see anything, no hands. Michael, let them know where they can find you at. LinkedIn, your number, email address, website.
Yeah, so you can find me on LinkedIn. I can drop my email and cell phone number in the chat here. Oh, there we go. Okay, thank you very much. And yeah, you can email me, call me, text me. I'm always available, always by my phone. So yeah. You can
I do
also find me on massmutual.com.
I do have a question, Michael. So I have years ago, I think I bought an annuity policy. I don't even understand. I still have it. It's not a lot of money. I think it's maybe like $10,000-$12,000. So at this point, I just want to like withdraw it and just take the money out. So would that be considered like an income? I just have to basically pay income tax on it.
Yeah, on the growth side. Yep. Well, it depends what it is. If it's an IRA, you have to be careful because there'll be penalties because if you're under the age of 59 and a half. But if it's non-qualified money, which it sounds like it is, you would just pay income tax on the growth side of it. So if your cost basis or what you put in was 10 grand and it's worth 12, you're just paying that on $2,000.
Would that be something I can offset with depreciation, or like if I have real estate depreciation or losses, can I offset it that way?
You would want to. I'm not. You could. I usually defer to a CPA on those questions, but like you could sell other investment assets as a loss theoretically to offset things like that exist in the stock market. But it would really depend on a lot of factors with your taxes.
Okay, thank you. I'll
Mhm.
schedule a call with you.
Yeah.
All right. Anything else from anybody? Tiffany? No? All right. So, I like to always end with, some mindset. And this morning, it was raining. I was programmed to do a run. And I really didn't feel like running because it was coming down hard. And I realized that whatever you set out to do, never negotiate with yourself. Be uncompromising. So whatever you're set out to do, whatever goal you're supposed to do, never compromise with yourself, never negotiate with yourself. So I will leave you with the quote is, the great secret of getting what you want from life is to know what you want and believe you can have it. So let's, sometimes we have to callous sometimes external factors, physical factors to go after what we want and go after what we achieve. I appreciate everyone being here tonight. It's been a long week. You had a long work day. I believe in all of you. We're here every Thursday. This is Wealth Without Wall Street. One of the things a pillar is generational wealth. That is a pillar that we stand on of providing value out there to you. So I really, really appreciate you coming this evening. Go after it. Go get it. Go get it this week.
Thank you.
Bye.
Thanks for putting this together.
Bye.
Take care.
Thank you.
Thank you.
Bye.
See y'all next week.
Thanks.